Okay guys, we're going to go and tackle chart patterns. Now, what I don't want this to be is a series of here's a pattern, here's how it works, and looking at multiple examples of things that many people, you can find this in books, you can find this on the internet. Instead, what I want to do is have a look at patterns from the perspective of how they are actually used, from a day trader's point of view. And a lot of this is not so much about, right, well, this pattern should do X, so you execute here, you target here. We'll talk about the basic theory because you need that framework to work from. And this is so much of trading. It's about having a framework to work within, and then the discretionary element of being able to trade within that framework. So we're going to look at the difference between sort of theoretically perfect examples, which you can find, and then the more nuanced versions, the reality of certain types of trades. Because what people don't spend enough time thinking about is what actually happens when one of these patterns actually comes to light. When you find a head and shoulders pattern, for example, which we'll touch on a little bit, what actually happens? How exactly do you expect the market to trade when you execute? Once you're in that trade, what do you think is going to happen there? Are you likely to reach a target? At what point can you start to consider maybe the target's not the one to be looking for? And how are you judging those targets? So that's the kind of thing I want to look into here. More the practical application of these patterns, as opposed to understanding the pattern in its sort of theoretical textbook nature, because anyone can do that side of it. It's the practicality of it, and it's the understanding as well. We'll bring in a bit of context. So a lot of examples that I'll show you may well be a short time frame, 1 minute, 5 minute example, but we'll bring the context of where that is happening on, say, a hourly structure as well. Because that's where the patterns really have the greatest power. It's not just as simple as spotting a pattern and repeating it. It's about spotting a pattern, understanding what that pattern means in the wider context. Because a small flag pattern can lead to a gigantic move, but only if you understand the context behind that. I've seen these types of things happen. 5 minute flag patterns in oil, for example, result in $3, $5 drops when you're looking at that. And if you measured it to the target, you might be looking for a 30 tick move, 50 tick move, so 30 to 50 cents, yet you're seeing $3 to $5 worth of movement, 300 to 500 ticks off just one 5 minute flag pattern. So the sort of theory of where to place your targets isn't necessarily what's going to guide how you enter and exit a trade. So first up, let's go have a little brief explanation as to why people are going to use a pattern. Now, the idea of a pattern is it gives a bit of strength to any kind of candlestick. Because if you're just looking purely from a candlestick perspective, one candle tells you this is a strong move, this is a reversal point, this is a point of indecision, whatever that candle tells you. But that's one individual moment in time. And that doesn't tell you a great deal about how the market got there, what it's going to do from here, how people are positioned. And this is what a pattern starts to do. We're going to build this up because pattern gives you a rudimentary understanding of positioning. We can then build on that as we move into volume and delta and other functions like footprint, profile. We're starting to, we're going to try and move through the building blocks here. So the idea of a pattern is that it gives you a bit more than a candle. A candle might say to you, here's a reversal point. What a pattern is going to be able to show you is where you can play that from, where you can expect that move to get to. It allows you to define a stop. Because without being able to define a stop, a trade is virtually impossible. Because you can look at what you might get from the trade, but if you can't balance that against what you're risking to achieve that, that ultimately doesn't lead to a trade. It leads to a gamble. And that's not what we're after. We're after trades. So it provides you this ability to say, right, I'm going to get in here, I'm going to get out here. So you've got this kind of map to work from. What it also helps you do, because you don't have to trade every pattern to the letter of the theory. You can trade a pattern in terms of giving yourself a directional bias. And we'll talk about the kind of prioritization of patterns as well. That whilst one pattern is in play, that ultimately becomes the sort of priority direction for a market, and suggests that until that pattern is invalidated, that's the overall area that the market wants to go to. It doesn't necessarily mean that you have to be in and swing trade in the whole move, but what it means is that you now have this idea of what potentially can happen over the next day, week, month even. That way, you've not only got an idea of what you're going to be doing, but you can then trade patterns within patterns. One of the crucial things, and with this we'll talk about as we go through, that you need to be picking up on is whenever you learn a pattern, learn the pattern from the perspective of this is what typically precedes the pattern, this is what the pattern looks like, this is how I can execute it, and this is how we're likely to move to the target. That way you've got this staging of what's going on, phases of the action, rather than just simply a fundamental drawing of what's going to happen. Now, ultimately, what a pattern shows you is the sort of logic or the thought process that is going on in the kind of collective view of the market. Remember, all a chart is showing you is the collective view of all market participants. And that is all it simply is. And so therefore you can infer positioning from any kind of chart pattern. So that way you can see how people are positioned. You can think about where people are going to change their minds. Put yourself in other people's shoes and ask yourself, well, if they're short here, where are they going to change their mind? Where are they going to exit that trade? Where might they add on to that trade? That way you get a much better picture and an understanding of the logic and the mentality that's going through everybody else's mind. This way, it gives you multiple options on how you execute that pattern. No two traders are going to execute the same pattern exactly the same way. Because if they did, you'd get this pinch point where everybody tries to execute at the same time. And as a result of that, you would get no one taking the other side of that trade. Because if, for example, I want to sell and I know that everyone's going to buy this break at a certain price, I'm not going to sell that price and nobody else is. So no trade is taken on in exactly the same way by every different participant. So you need to understand how it suits you, how you can play this trade. Give yourself options on how you execute these trades as well. So we'll start off, we'll look at the first example and we'll look at some of the elements that we're trying to tease out of these patterns and the things that you need to be thinking about in how you execute trades, how you execute different patterns. So, nice simple one. We'll start off with a flag or a pennant pattern. Now, the reason for me drawing them as a kind of diagrammatical form like this is so as to give people what I call a sort of mental map of what's going to happen. This way, it makes it so much easier to spot a pattern because this way you're not looking at specifics of it must do this and then X number of ticks here and it must do this and this and this. You're looking for a generalized form. That way, you can work within that framework and you can see the nuances of what are going on. No two flags are going to look the same and not every flag is going to look exactly like this. Perfectly drawn symmetry. Likewise, pennant, the same as well. But it's the principle of what's happening within this pattern, what the action's showing you, that is what matters. So, both of these, in the first instance, can be seen as a continuation pattern. A pennant arguably can be seen as a reversal as well as a continuation, and it depends really about the preceding action, because we're going to look at wedges and triangles later, which have similarities to pennants, but don't necessarily have the same preceding action. So we'll start off with a flag. This is perhaps the most simple of chart patterns, the ones that most people learn very, very early on. The idea of a flag is that you get a clear directional move. Now, after any clear directional move, the market needs a break. You think about yourself running very quickly. You're not going to be able to sustain that speed indefinitely. You need a break. You need to take a rest. And that's ultimately what happens. Because as the market surges up in this case, you start running out of buyers who are still willing to pay these higher prices. As such, the market then takes a bit of a breather. But the overall direction is quite clear here. It's to the upside. So then ask yourself, what's happening here as the market starts to pull back? Who is selling? Well, you're going to get a couple of different people selling. You're going to get those who have played the first move up, taking some profit, because when it first pulls back and doesn't then continue, people start thinking, maybe this is it. And they start to take a little bit off. So this creates a little bit of selling pressure. Now that's not going to be enough to turn the market over, because there's going to be just as many people looking at this move and thinking, great, we've now moved higher. I can buy. The market has now shown direction and they can start to buy. And so this is what creates the kind of support as the market pulls back. People are buying as it dips to get onto the next leg of the move. So they kind of cancel each other out. And the only real way that this falls is actually if you actually get a situation where you've got sellers coming in. People are going to look at this and think to themselves, yeah, that's gone to a point where that's perhaps as far as it's going to go and is now able to fall over. In which case, then the selling pressure comes in and the market starts to drop. So there's not many reasons for the market to actually fall back from here. So what you're now thinking about is continuation. Your mind needs to be on, how do I play this? The hard bit with a flag is because it kind of channels back down, it steadily falls, so progressively gets lower lows and lower highs, a kind of mini trend down. The difficulty there is buying the pullback. Often people try and buy on the dips. And what's hard about that is you'll consistently get pushed offside, which makes it very hard to define stop. Because if this does continue like that, how do you know at which point this isn't going to work? I know that the textbook theory is once you've fallen 50% of the pole, the initial move up, that's where the trade won't work. But in practice, this is a difficult thing to do. You're buying up here and you kind of have to have this arbitrary 50% point on the way back. It's not necessarily a definable stop. So you then need to adapt the way you execute the trade so as to give yourself a more defined stop. That's the way you need to think about it. Yes, of course, it would be nice to buy down here, but if you can't define a stop, sometimes that will work. Other times you get a significant loss because you don't know when to give the trade up. Whereas if you buy as you break the flag, so as you break this downtrend that you'll be able to draw on that consolidation phase, that's then the point where you can get in for the break higher. And so now it's all about expectations. You can define your stop when you buy on the break of the trend. You can either place your stop below the most recent low, or once you've moved higher, the trend will obviously continue onwards and you effectively get a stop that grows. So it does give you that kind of risk element. I would suggest then you have a situation where your stop can either go behind the trend or below this low, either of which is the point where you're wrong on that trade. Now, expectation wise, first up you get the theoretical target, which is the height of the pole. So you're expecting double the move again. Now, the difficulty when you think about the practicalities of trading, so get out of the textbook side of things, the difficulty of reaching the target here is that there's already a lot of buying happened. So you need to find the same amount of additional buying to keep this move going. Not only that, the higher it goes, the more inclined sellers may be to think that this is now getting good value to sell. Prices are rising. If you want to sell, you're getting better value. So you end up with this situation where you need to find more buyers in a market that, in fact, is perhaps increasing the number of people willing to sell. That's what makes the additional 100% target difficult. So at this point, you've got your kind of rough target, and we'll talk about that a little bit more in a moment. As you break here, there's a couple of sort of sections to the move. Because for those looking to sell, until you break this high, this is still a fair place to want to sell. Double top, bounce off resistance, the market can drop. So what ends up happening is you can end up with a slower move in here, followed by a more explosive move higher up, as we get to a point where there's very little reason to sell until price moves higher and brings in new sellers higher up. So you've got to think about the phase of this move and why that's likely to happen. Many people don't. Most people just assume that once you get in here, because a drawing like this suggests exactly that. You buy here, you get out here, nice straight line. And people have that in their mind. But you've got to think about what's happening along the way. Otherwise, you run the risk of getting in here, seeing this slow move to the recent high, thinking, this doesn't look wonderful, maybe I'll get out, getting out, and then watching the market jump and wondering why you set up through a lot of pain here for very little, and then watch the market fly. And the reason for that is you will face some difficulty here because people still feel that that's a place to sell. Once you got beyond the high, the reason to sell suddenly drops, and that's where the market can then accelerate. Target-wise, I'd always consider target as a point of reference where potentially you could find new sellers. Because not everyone's looking at this flag. Some people do not care about your 5-minute flag. As such, if there is a level here that is very significant, you may well not have reached the target, but people are still going to sell. And in that situation, you end up with a difficult moment where the market hits a level and you can get the pushback. So you have to understand where those decision points, like we talked about with support and resistance, where those decision points come in, and then look at what the reaction is to those points. With a pennant, you do have the opportunity to play this in either direction, because what a pennant does is it compresses positions. It forces buyers to pay higher prices. They don't get away with just laying bids and getting filled as the market pulls back. Instead, buyers have to keep on pushing their bids higher because there aren't enough sellers to get this move to the downside or to drive it down. Sellers are a little bit more passive. Now, what that suggests to you, if sellers are more passive, i.e. they're not rushing to sell as we fall, that can suggest that actually some of these sellers genuinely want to sell, because people who genuinely want a position, to take on a position, won't usually rush to get into that unless they need to. Whereas people profit taking, because they've got that profit and they want to take it, and we'll talk about this in psychology towards the end, because they want to take it, they're a little bit more eager to snatch it, to make sure that they get that profit before the market drops any further. So this now creates a compression of positions. You start to get more even building of positions, both long and short, not just purely selling because of people taking profit. As such, you can end up with a two-direction or a sort of dual option break here. You either break to the downside, in which case your target is back to where we came from, and I'll talk about this with what I call symmetrical reversals a little bit later, or you get a break to the upside, which works in exactly the same kind of way as a flag. Tricky area, whilst there's still argument for sellers to think that this is a good place to sell, followed by a more explosive directional move higher as that break comes, as you get to a point where there is very little reason to sell and everybody is essentially looking in the same direction. So that's a simple concept. And I would recommend with any pattern, as we go further and further through the course, it's not just about these basic patterns. These basic patterns are what I call kind of setups or tools. This is a way of defining an entry point and a stop in order to play a wider structural pattern that you have defined. So it provides you a methodology to get into a trade. I'll give you an example of this in a little bit. But with any pattern, as long as you can draw it and you can describe the phases of that pattern, it makes it so much easier to then spot them, because you're not looking for then something that meets a sort of perfect replica of a previously seen pattern. You're looking at something that has the hallmarks and the phases of something like this. So you can draw them out for yourself. It makes that memory side of it, and it makes the recognition of future patterns much, much easier, because you have this template to work from rather than this precise, here's a textbook version, I need to find exactly the same thing. Right, so let's go and have a little look at an example of some of the practicalities. First off, thinking about the pole, because the target that people will assign to a flag can be defined in different ways. You can define it as the clear directional move, i.e. from the beginning of this liquidation candle to the recent high. You could equally measure your pole from the most recent low up. Now, I'm sure there are varying different precise technical sort of prescriptions as to which you should do, but neither is going to give you an absolute certainty as to what's going on next. What I'm always inclined to do is to look at where the market can get to. I'll talk about this in a moment. So once this pennant forms, you've had the first directional move. So your bias immediately as this pennant is forming is this is potentially a move towards the upside. To start with, when you draw the top side of the pennant, because ultimately you will draw the top side first, this becomes a flag, because to start with, you've had a move higher, back, up. This could well be a flag. Once you get the higher lows come in, then you can start to see that this is developing more of a pennant shape. So this could be an either directional break. Now, your target, dependent on which of these poles you use, could be anywhere between 95 or 7 to 70 ticks. So big target, small target. We don't get to either of these. We don't reach either of them. And what ends up happening is once you break the pennant, you get this increase in volume. We'll talk about volume and delta up in coming sessions. Once you get this break, then you get, and you can see here, the first couple of candles, reasonably small, reasonably steady, not massively different if you took them in isolation to anything within the pennant. And then the more explosive move, as participation increases, as the reason to sell diminishes. Because sellers who have been pushing on the market to the downside in here, sellers who have been pushing down here start to exit, and this creates this rush to the upside. In terms of target, there's a previous reference point. This is an example I've taken from my own debrief, hence why I put single prints 15 to 30. There were previous single prints from a profile. We'll do profile in future. So this becomes your target, which doesn't give an insignificant move. That's still to the top of those single prints, 40 ticks worth of movement. And this is the quick move. This is why understanding next levels rather than just pure targets massively helps. Because here, that's the first point where sellers could come in from. So that's the first place of expectation for this to stall. Rather than stubbornly saying it's going to go to 95 or 70 ticks, look at where the market could stop. So this happens. Up we go. We then stall and then move on from there. The next leg gives you another 20 ticks, which still doesn't quite reach your target. And this is then a move that's derived less from this pennant and more from the structure that lay above you. So it's understanding what the implication of this is. That realistically, you may well have a decent target, but in reality, this is a pennant that doesn't offer you a gigantic move because of the wider structure and what that leads you into. Pennants also don't have to act as a continuation. A pennant can show a slowing down of movement. So what we've got here, and I've got this on a 60-minute chart on the left and a 5-minute chart on the right, and I'll move over this way so you can see. We've had a nice, steady sell-off. This is in oil. This was when volatility was extremely high, and when we were trading down in the sort of teens. So big sort of $4 move down throughout the day. And what we've got here then is a pennant indicating a reversal, but also context. Look at where we've dropped down to. This pennant forms down here at $12. That's this level just drawn in here. Forms down here at $12. This was the point where we formed a previous low, where we'd also formed a resistance point and then accelerated up from. So you can see why this is a significant level. Equally, this is also a retest of a trend. So you've now got a situation where there's a confluence of reasons why people might buy from here. Doesn't mean this has to be a buy. And this is where a pennant helps you out, because you can see the reasons that people might buy. You can also make the argument as to why people may well sell. There's been a steady sell-off. If we get through this area of support, there's not a great deal standing in the way before another leg down. So knowing that there is an argument from the buy side here, you can now use this pennant as a potential reversal pattern. And you're looking at the break of the pennant. Your stop then goes inside the pennant. In the first instant, when you buy on the break, you can put your stop below the low of the candle prior to the break, or the candle that breaks. That way you give yourself a nice, clean, defined stop, and you've got then a target moving back. And this is where it's slightly tricky, because you don't have this measured target, which takes away the element of predictability that people like to lean on. But what it does do for you is means you have to make your own decisions, which helps in terms of being able to say, right, well, where did something change? Where should I start thinking this move can get to? And as such, you're then looking up towards where this next leg accelerated down from. And that gives you, in this instance, around about 120 to 150 tick movement. You're looking at these previous lows as well. So that's how you're using the pennant that way. Whenever you get this confluence, and this is then using a 5-minute pennant to essentially play on what is an hourly or arguably even a daily level. It suggests more of an hourly type level. That's why this provides you with a much larger move than that other one, which perhaps looked a bit cleaner. This provides you with a clear 150 tick move. One, volatility is that little bit higher, but two, you've also got that structure that it's not just people playing the 5-minute pennant, it's people playing the hourly, buying the dip opportunity down at $12. So I'm going to go and have a little look at a flag break now. And understanding, because we talked about the sort of theoretical side of it, but understanding how the break actually happens and using a bit more context rather than just simply looking at something like this, which again is a 5-minute chart, providing you with a nice simple flag. We get this move down, steady move down, flag, continuation move. But no, once the flag breaks, you don't get a great deal of movement in here. You know, it's a pretty slow move. Not a great deal is going on. And this is where people become frustrated with a flag, because they expect immediate action. They expect to click on the brake, go on side and move to target. And people don't see what's between those 2 points. They don't think about the sort of landscape and the road that you're going along to get from your flag break to the target. Instead, they just assume it immediacy. And this is what I mean by no two flags are going to be the same, no two breaks are going to be the same. You've got to consider whether the break of the flag actually leads you to a wider movement. And this is where comparing time frames helps. You've got to also consider the way the market's currently trading. If you're on a very slow day that seems to lack participation, is this flag break really going to move in your favor? And if it does, is it going to move nice and easy in your favor, the way that everybody wants it to? You know, because ultimately everybody wants flag break, whoosh, straight to target. Of course you do. But you've got to think about those two things as you go into trading this. And as a result, once it breaks, you've then got to think, right, where's the drive element to this going to come from? And like I talked about before, this is typically going to come once you break this low, as opposed to when you break here. We'll talk about this more as we go further and further on, particularly when we move into order flow. Because what I want to do with order flow is then bring in and look at the kind of order flow on different examples like this. So you can see what the feeling is as you're in that trade, how it's going to actually play out for you, what you're going to be kind of seeing as the move happens. That's crucial. Live in that moment, living this period of frustration ultimately as the move doesn't actually happen. But what happens then is once you do break this low, this is where the acceleration phase comes from. And then you get a final exhaustion phase as you push through an hourly level as well. That's where the real action comes from. Like I say, the flag is a tool for playing a wider movement, not simply a pattern to be played on its own. This is where people get themselves in trouble with patterns, because they just repeat plays, they repeat simple pattern trades as if they will work every time. These work when they've got a confluence of reasons to work, when you've got people selling for other reasons as well. And what the flag does is it allows the market enough movement to get beyond perhaps the next level, which then allows for the wider move. So let's bring this in compared to the hourly. So you've got that small flag. All of a sudden, this takes on such a bigger story when you put it onto an hourly. This little flag that gets created up here, so around about the 1700 to 1695 area in gold, plays out here on an hourly. There's your 1700, there's your 1695. Note where this is. We've got just through the lows of a previous day, the most recent low. All of a sudden now, this simple 5-minute flag takes on so much more strength because this is now a way of playing the break of a significant daily low, the chance for the continuation, so that anybody who's been buying down here previously now is a little bit trapped and they're going to get forced out of positions. This is also going to bring in new sellers. So this flag, whilst it doesn't play out nice and quickly initially, it's the understanding of what the implication of that flag is and what it's taking you towards that allows you to look at this and feel that this is still worth playing and this is still worth sitting through, even though there is frustration. But give yourself options. You don't have to sell on the flag break. And if you do sell on the flag break, you don't have to put all your position on. You can add as you break the low, and that can then give you the next leg down. And then the final leg comes as you start getting to a point where everybody gets pushed out of the trade and you get this acceleration down. So it's not just simply a 5-minute flag. This is a flag played on an hourly perspective at the same time. And that produces this nice steady movement. Not all flags are going to do that. And some flags will produce this much quicker move. Often in a situation where perhaps the market has got that greater dynamic and that greater ability to move, more volume getting pushed through at any one point in time. Unlike that breakdown that we just looked at in gold. Like we talked about with support and resistance, significant levels, so significant daily or hourly lows, are going to find support around that level. Whereas here, what we've got is a market that's moving higher, but only over the last couple of days. So you don't have this huge position. This isn't a major significant level here. So the break of 65.41, whilst it is a daily low, it's just purely within range. And so the break of the flag that almost immediately reaches this level, the low on the flag just here is at 47. So the 6 ticks through the flag is enough to break the daily low, which is then enough to bring in new sellers. And this is why in this instance, you can end up with a much quicker break towards the downside, because there's an immediacy with which the flag break moves the market through the low. And so the sellers on the flag get themselves through the low, and that then drives the move on to the next leg. This is why in this instance, you end up with this much quicker move down. This is on a 1-minute chart, not on a 5-minute chart. On a 1-minute chart, you get this nice, swift 70-tick drop. And that again is all about the context. It's all about understanding what the flag leads you towards, not just simply saying, oh, well, look, it's a flag break. And you need to be able to understand the difference between why this flag drops straight out of the sky and requires a different methodology for execution than the previous. With this flag, your options are, in fact, reasonably limited. You have to sell it on the break, because if you don't sell it on the break of the trend, the last chance you're going to get is to sell it as it breaks the low of the day. If you miss that, you've missed the move. So the urgency and necessity of how you're going to execute this changes. You need to be considering that with any kind of chart pattern. That no two are going to be the same. And the structure that leads into it is what's going to tell you how you're going to execute this trade. So far, what we've looked at is reasonably short time frame patterns. 5-minute flags, 5-minute pennants, 1 minute, things like that. Even the gold on it, which is ultimately an hourly flag. But you can also get your kind of daily ones. Now, a daily flag is less about a flag that, or a sort of larger structure flag, is less about a flag that says, this is your target, we are going there. It's about looking at it from the perspective of saying, okay, we've now got a directional bias. And until you get a counter pattern or a reason to believe that this won't continue up, you can assume that on a day-to-day basis, you can come in with a bias in this instance that is tilted to upside. This is an example in Euro stocks, an example of a steady move up around about 230 ticks here, followed by a week-long flag. So you go into that week and you see this developing, you use that kind of fractal nature here. We talked about the idea that after a very straight move, the market effectively needs a break. That's what happens. So you can go into this week almost expecting this, or at least expecting some degree of settling down. That happens, then it breaks. Your view is this is a market that is moving to the upside. And you can maintain that view until you get to a point where this comes into doubt, comes into question. Once you start to drop back below, you can maintain this view until this starts to come into question. Once you start to drop back below the breakout at the end of the week, or even the initial high on that flag, you can maintain this bullish outlook. That's the way that you're going to be using this as a day trader. It's not about trying to swing trade this whole move. It's about looking at this and saying, okay, now I have got some clarity of what I want to be doing directionally here. And this is an almost identical pattern in Euro stocks later on the same year. Very, very similar, steady move up over the course of a week, followed by this sideways consolidation. Market needs to balance out. Slightly quicker flag built here. Flag build, bullish bias going into the following week. And then you're looking at this from the perspective of, right, I can remain bullish until I see a change. And what ends up happening here is once you've moved higher, we get this sort of sideways range structure. I'll talk about ranges in a little bit, that fails to the upside. Now your mind can change a little bit. Now you go back to being a bit more neutral on what's going on. And then once the range breaks to the downside, the change is confirmed. You could play that move to the downside because remember, you're doing this from a day trading perspective. You're not expected to just be long for all of this. But in thinking about it from the longer time frame perspective, you know that people will be long through all of this. You also know that some of those people are going to be thinking, I'm going to trail my stop. And so as it moves through that low, this is what's going to initiate some selling. And the more time it spends below this range, the more sellers are going to think maybe that's the top and maybe we can drop from here. So that's what you're going to start to try and think about. That there's one thing to use these patterns as a way of executing, of getting into a trade, but there's also that element of understanding the wider patterns. When you see a flag over the course of 2-3 days, 2-3 weeks even, then when that breaks, you've got this sort of wider, more generalized direction. And it's about always looking at it again, right, until I see a reason to change my mind from this time frame, I can maintain a bullish bias on this market. Next up, we're going to tackle double bottoms and double tops. Now, this is essentially a pattern whereby using a simple support resistance methodology, you can play it. But there's structure behind this. And this helps you then understand where people become more active in a trade. Because simple support resistance doesn't necessarily lead you to any further direction. It suggests a point, like I said before, where a decision can be made and a market can react. But once it's reacted, it doesn't have to do anything else. And you need to then get to another point that then instigates a second wave of action before a market's then going to put in direction. So let's go and have a little look here. Simple concept, no one's going to be surprised by this. But the simple concept is we move higher, we hit a high, we hit the same high again, and the market drops. From here, there's your double top. So where do you play this from? Technically, the sort of textbook theory way of doing it is you do nothing until you break this low. And there's logic behind that, because this could well be a pullback that forms a sideways range. It could well be a pullback before another leg to the upside. And there's no way of knowing this. It's about the reaction, the decision here that says there are no more buyers, or there are not enough buyers to overwhelm the sellers that are there, followed then by what happens here, the next leg of the action. So you can play this in multiple ways. The textbook way is to play it on the break of this low, which is going to bring in new sellers. And in terms of targets, equally, there is a measured target, which you can do as the high of the double top to the low in the middle of them. And you can project that down. So you double that down. And you can do that. And I think in terms of measuring these things, people spend a lot of time trying to be ultra precise on this type of thing. Now, there's so much variation here. Very rarely are you going to have a double top that stops at exactly the same price for the reasons we highlighted in support resistance. So which high you use immediately creates this variance in target, because some will use this one and some will use this one. So there you go, you get different. So in reality, an easier way of doing this is literally to be simplistic and look at an approximation of target and measure it. And you can do it with your fingers on your screen if you want to, because what you're looking for is not precision point to exit. You're looking for what's around that area. So if you look now where my thumb goes, somewhere down here, you're now thinking, okay, that's a feasible target. Could you understand a reason why people would buy from here? Yeah, absolutely. So now you've got yourself a target that is realistic, because at this point, this is where other buyers may come in. This is now a decision point rather than a point to say that is absolutely the target on this, because you will have situations where it hits there and then continues onwards. But the first leg, you're looking to that first reference point. Second leg, if there's still enough selling, you get continuation. So you've then got to think about how you play it. This can be played as a trade on its own and just simple level, two-level scalp trade. Give yourself options. You can play it in what I call the aggressive style, that you predict the double top when you're here. Now, there's a lot that needs to happen for this to be a double top. And so if you're doing this and going on the what I call aggressive style, you've got to think about what are you trying to achieve. Because you could play it from here and play it down to here, level to level, resistance to support, trade done. Now that's not a double top trade. If you want to play this as a double top and you're entering here, you need this plan before you get in. You need to be willing to say to yourself, I'm going to sell it here. I'm going to sell it at the previous high. And I'm playing double top. Therefore, your target is here, at least. As a result, you have to maintain your stop above the high and equally be willing to see the market go down here and do something like that and be willing to give up this unrealized profit. Now, if you're happy to do that and you can find that this works consistently for you, then great. But what you've got to have is that in your mind beforehand. You've got to have that plan so that you can understand what you're trying to get out of the trade and make your trades comparable. Otherwise, you end up in a situation where one week you get out here and you think it's a great trade. Another week you get out here and you think it's a terrible trade because it continues. So it's about understanding what you're looking for on that trade. The hard bit about playing the aggressive version is how you define a stop. Because if this is a recent high, how many ticks through has it got to go before you can say that you're actually wrong? And this is what makes this type of trade very difficult. It's fine if you get the quick flick to the level, sell it, reaction immediately, because then you've got a defined stop. But if you don't get that, this is where it becomes a much trickier trade to actually manage. In reality, a good way of trying to be able to play the aggressive entry, I think this as a method for doing it allows you in at these points where you get, because the double top is rarely ever the same price, a market that breaks it slightly and then falls back below. And we'll talk about this in entry exit style as we go on later this week. Once it falls back through this high, now you can sell the high with a defined stop above the red line, above the recent high. Now you can play this because you can say to yourself, right, I've got a minimum target here. I've got a defined stop. That makes a viable trade. I'm happy with this. It's about giving yourself options, giving yourself a multitude of different ways of playing it. And we're going to look at slightly more nuanced versions of double tops in a little while, of using a double top and then a further structure to then play the trade essentially from the middle of this area, for example. It's all about what's been presented to you within this framework rather than what precision you're trying to look for. Think about it in terms of what are the salient points of a double top and how do they then fit into what your market's currently doing. It provides you a framework for identification. Give you an example here. This is looking at a daily one. So obviously this is a pattern that is going to give you directional bias more so than anything else. But this goes to illustrate the imprecise nature of many chart patterns. The structure's there. If you didn't have any numbers there, you'd say absolutely that's a double top, but that's in fact 16 ticks apart, those two highs. So it means that the aggressive entry isn't playable because you can't sell it at 77 and say it's a double top. Because if you think there's 16 ticks worth of variance to the downside, i.e. you can gain 16 ticks ahead of the level and that's okay, that also implies 16 ticks above as well. So that's giving you a minimum 32 tick stop. Realistically, you got to go over 32, so 33, 4, 5 tick stop on a trade. So that's one element here. But really, this is about guiding opportunity. If you look at this in a slightly shorter time frame, what's happened here, if you ignore this part over here, you've had a move higher, pullback, continuation that fails to break the high, and then breaks the pullback high or the initial high. So now you've got an early confirmation here, and you can use that day as a way of playing down. So from this point, now you've got a structure to try and play short down towards this low. So you've now got the double top, the failure of a flag to continue, to now from a daily perspective play this down. And once you break this low, now you've got the confirmation that you can have a downward sloping bias on this trade. Measured target on this gives you around about 600 tick move, and that's the move over. You do get reaction from it, but that's because it coincides with a couple of previous lows. And it's not about absolute precision. It's about, again, looking at this and saying, well, approximately there gives you the same area, and look what's down here. There's some support. That's the area where realistically this may well run its course. It doesn't, and you get this steady continuation on from there. But it's the structure. It's about seeing this pattern for what it is. You've got a double top. Once you break this low, your bias is down, and your bias is down until you get to that low. Once there, then it's a whole new trade. And it's about the decision that happens from here now as to what brings on the next leg of the move. With patterns, you have to make sure that you're comparing the same things. You can't look at one double top and go, wow, look at this and put in a gigantic move because this part of the move here doesn't relate to the bit that you could consistently say is expected on a double top. And so therefore you're not comparing the two things the same. Right, now I talked about a slightly more nuanced version of this type of thing. And this is what I mean. What we've got here then is a double top established on an hourly perspective. And you can play this in multiple ways. And this is what's so important. So, I'm not trying to look at this as here's a double top, this is precisely what happened, and this is where you should get in, this is where you should get out, because that makes it too sort of prescriptive. You need to look at this and say to yourself, okay, we've got a double top, quite clear. You've probably also got a minor double top within the day, just in here. We've also got this false break element, and you've got your secondary highs, which we're now, once again, using as a resistance point, down at 15.59. So now you've got this additional reason that this can go down. And so this gives you multiple options as to how you can get into this trade. And again, it's about thinking about the wider perspective as well as the individual trade itself. Individual trade here, you can look to try and play this down on the day, perhaps to break the low of the day. You can be looking at the wider move. But it allows you to kind of form judgments as to where different phases of this move can happen. And if you can see the different phases, you can play those phases. You can play the phases that suit you. Are you somebody who is more inclined towards a passive trade pullback and then steady move through the low? Are you somebody who prefers a breakout type trade and the accelerated move? Are you somebody who prefers to play on that final panic exhaustion move? Because there's 3 separate moves in this. So at point 2 then, you're going to think, right, what's the next phase of this move? When we talk about ranges, I'll explain this in a little bit more detail. But there's your double top, double bottom low down here. And that comes in all the way down at around about 15.27. But this double top then brings you onto this support zone. You've effectively got that kind of pivot situation within a wider range. Get into this range, and this is the point where everyone who's been buying in the range is now looking under pressure. And with that, they will then start to exit as you fall into the range, giving you the potential for what we call a range sweep, which we'll talk about again in a little while. So that gives you a different move. And still, this isn't a double top yet. It's only a double top when you break the bottom of this area. That's when it becomes a double top. That's when the acceleration phase can come in. But that acceleration puts you back down onto another small range. And so again, the way you play this trade can be in phases. You can play that phase there. There's 100 ticks in that. You can play this phase here. There's 140 ticks in that. You can play this phase very, very steady, and there's 150 ticks in that. But different phases are going to need to be played in different ways. And that's the bit that you've got to think about. At what point is things really changing? Because to start with, not much is changing here, and this could just be a sideways range formed here. Once you break into zone 2, now things are starting to change. People who have played on this move are now looking in trouble if they've been buying. Move can accelerate. Now at point 3, everybody up here who's been long, buying for a continuation, is now stuck. And this is where you can get that additional sell, coupled with those who are technically playing the correct double top and start to sell on the break here. So we take this onto a shorter time frame version, we can look at those different phases, or certainly the final 2 phases. So we're going to look here at this phase through the range, followed by this phase out of the range. So you're looking at the move from 42.8 to 28.6 to 18.4 and beyond. And you see then what happens. This is the move from 42.8 down to 28.2. You fall into the range and you get this steady move down. Buyers start to give up. You get this steady little initiation of selling through that recent low, the low of the current day, but then you don't get this rush and panic down. You get this steady movement down through the range. And that's quite typical to see. And I'll give you another example of this in a little while. So you get the steady move down through the range. Now, once you break 28.2, this is the point then where everyone's now thinking this is a double top and the market can go down. So buyers are now in trouble. Sellers now are able to come in and sell more. Now you start to get the acceleration, and this provides a much, much quicker move. 28's down to 15. So the same size move that you get here is done in a matter of 4 minutes. This move takes a whole hour to do. It's about understanding the different phases and pace of movement. The reason for that is at this point, there's very, very little reason for anybody to be looking at this as a buy opportunity. Whereas whilst in the range, there's still reason that people are going to think to buy this. That they're playing into that much wider range. And as long as 28 holds, buyers are still happy. Once you break there, everybody's looking in the same direction. This gives the much faster exhaustion phase of the head and shoulders, not head and shoulders, double top pattern. Now I wanted to look at reality as well, because a couple of them that we've looked at so far provide you this kind of perfect view of, oh, this is how it works, and this, they work lovely. There's a reality to trading a double bottom and any kind of technical pattern. This is one in the S&P, one that's created over a 15-minute session. I think it's 15 minutes. No, sorry. We have a half an hour phase of trade. So it's half-hour chart, not 15 minutes. You've got to look at this in terms of, again, options and not giving up on the idea. So what I mean by that is prioritizing what's going on here. The double bottom maintains priority over all other pattern here until it is broken. We've had a move down, we hit a low, market then starts to reverse back up. So this is a viable pattern until we start to get down here and get through that low. Get through that low, boom, pattern's gone, trade's over. So the reality of this is, because the pattern's going to build, the opportunities will come in, you get this simple double bottom. This is a way of playing a reversal out of this move down that we've had. Now, your first entry is going to be here on the break of the blue line. That makes perfect sense. So you play this reversal breakout. Now, your minimum target here is to get through this high. And there's no way, when you look at the reality of this, that you could say you could have got out anywhere before that. Why would you? There's no reason to. So you've got to look at this and say, okay, I'm going to have to accept on this trade that I can still get stopped out as we come back below that low. Sorry, below that high. Once you're back below there, game over, you get out of the trade. And you are going to get stopped out there because you get no confirmation. You get nothing that says this is a break towards the upside yet. And so as a result, you buy here, you get stopped out. And that's fine. But it hasn't changed the overall structure. And yes, that can be frustrating. You think, well, if only I didn't get out. But there's going to be other days where you get out and soon you're trading below the low. And absolutely, it's the right thing to do. So you have to work with the information you've got at any one point in time. This is where, looking back at patterns, you can find easy explanations to how they work without looking at the reality of what you're going to do. Reality is you're buying in here, you're getting stopped out. That's fine because you get a second attempt. Now you form this kind of wedge pattern. You've got this recent high. That was the point that it failed at the first time up. But now when that breaks, now it opens up the second attempt. The double bottom is still in play, but you play it from a different point. So your priority of direction, your bias is still maintained. It's just the way that you play the trade, the options that you give yourself in how you execute this trade that matter. So make sure you're always thinking about the reality of, has anything changed yet? Do I need to be out of this trade or do I need to be out of this idea? You can be stopped out, but don't let that be a reason that you won't take this trade again, because that's where people get themselves in trouble as well. They get stopped out and they go, right, that pattern's dead, not working, not trading that. It's just the fact it didn't play out the time you got in. Doesn't mean that it can't play out and it can't work. It just means it didn't happen when you thought it would. The structure's still there. The opportunity is still there. You need to find your access. We talk so much more about access, particularly when you move on to order flow, what you need to see to access this trade. Okay, moving on from a double top, something similar, a head and shoulders pattern. Ultimately, it's a reversal pattern from the end of a move. But the difference between a double top and a head and shoulders is the way the move ends. A double top essentially is a move ending with at least a short-term sideways range that then falls back on itself. A head and shoulders is a move ending with a failure of trend to continue. Now, you will always hear the reference that any kind of double top or double bottom or head and shoulders patterns has to come at a high or a low. And the difficulty I always found with that to start with is like, well, where's a high or a low? And you obviously don't know this until the pattern has played out, that is the most recent high or low. But the way that you need to be thinking about it is that most recent swing. So a head and shoulders pattern, if the prior move before you've got to here has been a market that's traded up here and then traded down and your head and shoulders is here, I would argue that this isn't necessarily a viable head and shoulders. It's bang in the middle of the range. As such, I wouldn't be looking for this. Or that would be one of the first ticks as to, do I really think this is a pattern I want to be participating in? So here's your head and shoulders pattern. What you're looking for, and think about the progression of this. You've got what's beginning to be a trend move. Higher highs, higher low. This is then the problem, that this high doesn't exceed this high and maintain the trend. Now that's not a reason to sell it, and this is the mistake people make so often. They see this and they see the market up to here. So they get to there and they go, we've got a head and shoulders, because they can draw what's called the neckline between the lows from the shoulder to the head and then the next low to the next shoulder. So the lows in between those is where you can draw the neckline. Connect those two and that gives you the point where you can enter the trade. But people see this and start selling. The problem that you have here is that we could drop down, hit the neckline, back up, break the high. It's not a double top, it's not a head and shoulders. This is just a stalling within a wider trend and nothing changes. That's why that's so dangerous. Don't jump to conclusions of patterns until the pattern is formed. Now, once you get the pullback, this is the bit that you're looking for. You're looking for the break of that neckline. Once that's through, then the move's on. Then you can start to play this for a target which is equal to the height from the top of the head to the neckline. People will also measure the target to the first shoulder low, to the second shoulder low. So you've got a multitude again of targets, of variation in your target. You can also have upwards, downward sloping head and shoulders. There's different ways to think about either of these. So we'll tackle the upward sloping one first and look at also where is it wrong. Once you break the neckline, until you get back above that, there's no reason to think that this can't continue down. So what you get then, sell off, you can have a bounce back, which bounces back, meets a resistance, and then continues. So as long as you stay below the neckline, the trade is on. This can make it slightly difficult, particularly because this neckline is going to progressively move away from you. So your stop essentially gets wider. As a way of playing with a more defined stop, once you break the neckline and this low, the low of the right shoulder, then you can move your stop to back above here. It does run the risk that you get a situation that looks like this, the red line, and you get stopped out. But again, you've got to look at the reality of it, the practicalities of playing this in a certain way and giving yourself a continually widening stop. But it doesn't change the overall structure. And so if you do get stopped out here, that still suggests that you have the opportunity to sell it on the break here. Now, with the upward sloping necklines on a head and shoulders to the upside rather than an inverse, so mirror image, the downside, what you do have the opportunity of is points to add on the lows of each shoulder, or additional entry points. So you've got options. What it does mean is that this is perhaps going to be one that's a little bit trickier to start, because you can see why people are going to come in to buy this to form a range or to play for a second leg. But once they've broken, there's no reason for this to stall. And then you can look for this roll back down. Whereas with a downward sloping neckline, by the time you break the neckline, you've broken all of the recent supports. And as a result, you've now got the situation where there's very little getting in your way. However, you've also got a situation where you're getting very close to target by the time you enter anyway, because the fact that the downward sloping neckline constantly pushes your entry point further and further away from you, closer and closer to target. So there's differing considerations for each. This one, not much to get in the way, but smaller target. This one, a few reasons why it may not work initially and where it could be tricky to start with, but you get multiple opportunities to add and a larger target. So make sure you've got that in your head and in your mind as you're taking these types of trades on as to how exactly you want to play them. Talked about using patterns as a method to execute something that you're already looking at, a pattern that you're already looking for. And this is a prime example of it. It's not that you've steadily watched this head and shoulders build up and then played the trade. Instead, this is a situation where you've got a trade in mind. You've got a plan. Your plan here is that you've got this little blue box, which we'll talk about when we do profile, and I'll come back to this example. As I've said, I'll try and bring examples back to give you more color. You know, essentially there's one part to this, which is this head and shoulders, but there's more structure behind this that gives you the reason why this head and shoulders pattern has that little bit more clarity to it. So what we've got here then is a structure on an hourly that would give you fair reason to want to sell in this little box towards the upside. Now, I talked about a head and shoulders within a range, and that's exactly what this is. But on the day, this is a move to the extreme of the day. So this head and shoulders is formed at the top of this green candle. So on the short time frame, on a 1 minute time frame, this is at an extreme. Within the wider structure, it's absolutely not, but it's at an extreme at a point where you might want to get in. So what's happening is this head and shoulders is now giving you a structure to play a trade that you're already looking for. If you're already in, and you quite feasibly could be from up here, just here, brilliant. The head and shoulders pattern is now giving you a chance to add on to this trade. If you're not in, then the head and shoulders is now an additional method or a way of accessing this move to the downside. You know, imagine that you hadn't sold it up here. You decide, I'm not going to sell it up here. I'm going to wait for a trade. You don't know what that trade is going to be if you're not selling it there. So you then have to look at, okay, now I've got head and shoulders. Now I know where my trade is. Now I know where I can execute. I can execute on the break. That's going to give me a nice clean move back down the range, which gives you a move back down to where the break towards the upside started from. So within the day, you're playing in line with the structure that you've already defined from an hourly. You're using a 1 minute to access that trade. gives you defined entry points, clear stops. It also gives you a second possible entry as well, what I call a passive retest entry. Retest the neckline, you can see where you've got previous resistance as well. So from the point of view of people wanting to sell, some people are just going to sell because of the previous couple of lows, some are going to sell the head and shoulders. This gives you leg number 2, which gives you a minimum target of a break of this low and then the continuation down the range. That's how you can use context and use the short time frame head and shoulders to execute trades. It's a tool to play what you're already trying to do. The other thing I've not touched on too much, but I did with trend lines, is that these things are more art than they are science. It's the structure that matters. This is a pretty, for want of a better word, a pretty ropey looking head and shoulders. It's far from your nicely drawn map of a head and shoulders. It's far from what you're going to find in a textbook. But the principle is still there. That what we've had here is a move higher that has a pullback that goes higher. It's a trend move that has a pullback. It's still a trend move that doesn't go higher. Now it's potentially a head and shoulders. It's not a head and shoulders until the neckline breaks though. And this is where a 2-point trend is a necessity. You draw your 2-point trend, that breaks, and then the move happens. But the pattern itself is pretty ugly. It doesn't fulfill what you'd expect it to look like. But the structure of what's happening is exactly that. That you've got disappointed buyers looking for continuation, they don't get it. And when they don't get their continuation, the buyers who have been playing this leg, the buyers who have been holding on from this move up, that bought here, are now in trouble. And as that neckline breaks, and as this low in particular breaks, this is then where the next leg of the move goes. In terms of target as well, it's easy to look at this and go, right, there's a 100 tick target on the head and shoulders. You do get a 110 tick move. Should you be taking 110 ticks out of this trade? It's easy to say, yeah, well, absolutely you should. But target-wise, you shouldn't, of 100 ticks. And realistically, you want to look at what reference points you've got. We'll talk about grind reversals a little bit later, but this is essentially that. This is a grinding phase. So there's no clear support in here. So there's no reason for it to stop in this phase. There's your first pullback before this move starts. Grind, pullback, move. And that coincides with a previous high as well. That's going to be your realistic target, which is around about 90 ticks. Is that a bad trade? Absolutely not. And that's a more replicable trade. So it's about looking at the structure on a whole and then taking your target for what it's showing you is realistic. Don't just assume that things have to work textbook scientific precision. We'll look at this later on in a more dynamic way because this is what I call a head and shoulders that's in play. At the time of recording, this was happening. This was a situation that we had in Eurodollar moving to the end of November 2011. And what we've got here then is this very wide head and shoulders pattern. This is formed over an entire nearly 2 years. So this move runs from the beginning of 2020 to the end nearly of 2021. Very, very large daily head and shoulders structure. So you've got to then look at this in terms of, and I want to bring this to light, so I'll bring it onto a shorter time frame in a moment, looking at the little parts of the trade where this is a head and shoulders that's actually playable. It's actually an opportunity. So what we've got then is we get the break of the head and shoulders, and then you end up onto this key support zone. Once that breaks, now you've got the opportunity for the larger move. So you're already going to be of the view that this is a head and shoulders break. And the way it breaks actually kind of ruins the theoretical textbook nature of it. But if you look at what this all implies, head and shoulders implies reversal. Where does the reversal come to? This support zone, previous high, secondary high. Could the market stop there? Absolutely. So this immediately says to you, this is a zone that could be difficult to trade in. Do you think people would buy it there? Yeah, absolutely. Day time frame participants thinking the euro can remain strong could well come in to buy it there. So it's about then looking again at this from the point of view of directionally, you've got a judgment. Trade in this zone. This is where it becomes a bit more neutral. We could spring out of here and that be the end of the move down. Equally, you can get the breaks to the downside and then you're looking for your next targets through this range, down to this support, potentially all the way down to 108. And what then comes of this, which we'll see and we'll go and look at a little bit later on today, So that's the way that you've got to start thinking about this, that these wider time frame patterns give you this opportunity to then have this very clear view, particularly on the break of this range, knowing that this is essentially the way I think about trades or situations like this. This is the last chance for buyers. Buyers want to maintain this as a move up. They need to come in and buy it here. And if they don't, once it breaks that zone, that's where the move's coming from. So this is the reality. This is that support zone. So you can at least go into this of the view that this may well not drop straight through. It may well be something that is going to fall in and struggle. And as soon as it falls into this zone, nice down, flag, down, doesn't break the bottom of the zone, very quickly you can start thinking, right, one of two things are going to happen here. This is going to be a reaction and out the top. Doesn't happen. You get a steady sideways action. Brilliant. So now you've concluded that this could quite easily be just a sideways range for an indefinite period. Then you need to start thinking about the break. Either you're going to get a break to the upside, and there's one clue that it breaks and fails. So that's now slightly tipping your bias down. And then you can start looking at the potential of a next leg down. That once you break the bottom of that range, you've got a lot of space. We've got space to move now. First target goes down all the way to 113. Now again, it doesn't mean you have to swing trade this down, but what it does suggest is you can play downward bias trades, particularly something like here, some break through the low of the range and the recent low. That gives you a nice structure to then play down. And you're looking to continually play down until you've got down towards 113 before we then start to get a short-term bounce. But this move here does give you that full move down through that previous range. You just have a quick look. Here, we have the move down through to 113. The next target is 111.31. We get down to 111.90, so we don't fully reach the second target before. And that's down to 111.90. We don't fully reach the second target before we start to get a bounce. That doesn't necessarily mean the end of this head and shoulders pattern. It could well be a short-term stall after a very clear move down, and that's what we're going to have a look at later on. Structure massively helps on head and shoulders patterns as well. That as the head and shoulders pattern breaks, you can add to that a structure as well, that this is a turning around of a wider situation, a wider context. All of a sudden, this takes on so much more power. So what we've got here then is an hourly chart on the S&P hitting record highs on the back of non-farm payrolls. So this move up here is this break up here. And then a head and shoulders pattern forms. Now, he talks about sessions. What's happened here is the head and shoulders pattern forms as a result of main session, cash session. The head is formed as a consolidation in the overnight session. And the second shoulder and breakdown is formed in the next cash session. So essentially what's happened is you had a cash session break up and an inability of the market to continue, and then a cash session roll back down. But what adds to this is the fact that the head and shoulders break. So if you draw the shoulder, so there's your neckline, comes pretty much bang on the high of the spike up on payrolls. So it's about bringing in these references that you've got. The inability of the market to stay above the high created on non-farm payrolls is a chance for the market to fall. Couple that with the head and shoulders pattern. Now all of a sudden you've got this clearer reference as to how you're going to play this, that this takes on that much more importance once you break through that 14.25, rather than just simply being a pattern that rolls to the downside. On top of that, you've had this drive up in the previous cash session. And that the inability to keep that going is also part of the reason why people are going to exit. Those who played the break looking for new record highs and continuation, all of a sudden have that taken away from them. The break below 14 quickly moves you down towards 08, which was the previous record high, comes in around here, and you can then get that acceleration through 08, flag, continuation of move down. So it enables you to very quickly change your view as to what's going on. This is a break to record highs, but it's got the structure to fail. And as soon as it breaks this low, and breaks the neckline and the 14s, the head and shoulders high, the non-farm payrolls high, straight away you're thinking, there's not much more in this. And you can now very quickly adjust your perspective, adjust what you're trying to do, and play this to the downside. Right, wedges and triangles. Now, these are patterns that don't necessarily have to be the end of a move or a continuation pattern, and are more something that gives you a way of looking at compression and positioning within a market more so than anything else. So whilst the ones that we've looked at so far, in terms of a flag or a pennant, can be used for a continuation or even a reversal, We looked at double tops and head and shoulders, reversal type patterns. What we're looking at here then is compression. And what this means in terms of people getting themselves positioned one way or another, getting themselves perhaps trapped, if you will, expecting something more of a move. So there's two different types that I'm going to look at here, both of which are concerned with people getting essentially forced into a corner. So starting off with, what we're going to look at is a wedge. And this is a downward sloping or descending wedge. You get the same on an upward sloping or ascending wedge, typically at the end of a directional move. When we look at delta, I'll bring in a method to use this in conjunction with delta as well. So it's about, again, adding color to a pattern. These types of moves are something that colloquially on the trading floor, we refer to as a kind of smoking chimney move, particularly ones to the upside. You get this drive up and then this steady sort of drifting onwards. But what's happening here then is once you've had this directional move down, rather than the market getting this bounce back and creating this kind of pennant or flag formation as people take a break, buyers start coming in, sellers then sort of step back a little bit, allow the move to bounce back before then coming to sell at better, at higher prices. Instead, what's happening here is you're getting a progressive concentration of positioning lower. Sellers are not allowing this to bounce. Sellers are constantly moving their offers lower and lower and lower. It's almost a slow desperation type move. But they don't want to wait for it to bounce and sell as the market comes up. They move their offers down. They sell at progressively lower points and also are willing to try and push it through the lows. Each time you reach lows, market pushes through that little bit. This creates essentially, think about your average position. If you sold here and then down here, your average position comes in here. You sell again, your average position moves marginally lower, but constantly the market's washing around you. People get this heavier weighting of position towards the low. So you'll get skewed short without seeing progression. And because you've not had a pullback on this, it becomes very difficult to define stop again. As such, each of these pullbacks are going to have a stop placed above them. People are going to get out as the market pulls back beyond the point where they feel some pain. And so you can end up with this progression of stops up. As a result, what can happen and what you're looking for in a trade like this, and it becomes a much more difficult one to the downside than the upside. So it's almost the case that you can look at this and absolutely this can continue down. There's nothing to stop this going down. That the market could drop, break the bottom of trend, and then accelerate down. That could happen. The hard bit with that is this is purely an order flow thing, and you've got to find a situation where that move down has a very distinctly different way and nature to it than what it's done on the previous breaks. Whereas to the upside, what you can look for is a move that progressively accelerates. So a little bit like a flag. There's going to be some people still selling pullbacks as we bounce, all the way typically up towards the initial sort of peak of the wedge. But equally, you're going to get some of these compressed shorts progressively getting out. So you don't get this rush of people exiting, but you get this progressive sort of stop, 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 stop. People just falling over each other, chasing themselves to get out. So this creates a move that actually accelerates the higher it gets. Typically, what happens is you will have a market that moves higher, accelerates and slows down. With a move like this, you're looking for something that moves steadily higher and then accelerates up. As you start running out of the people selling, people will sell on the bounce, sell on the bounce, sell on the bounce, sell on the bounce, and then they all start to get stopped out together. And so you get this much sort of steady speed type move. So that gives you your compression in a continuation manner. What you can also have is a triangle. So a flat topped or flat bottom triangle. This equally is showing you progression. Now, this can break in either direction. Either, and using a flat topped triangle, this will break because the sellers eventually get overwhelmed up here. People who have seen this move up and effectively held the market. So this is showing a situation where buyers are strong. Buyers are willing to keep on paying slightly higher prices, which does, like a wedge, compress people's long positions closer and closer to the top. Now, if sellers consistently sell here, this level eventually gets weakened, like we talked about in support resistance. So you have a situation where people who are short here may well get forced out and you get this quick jump above the high. So you can get two different moves. The move through the high, you can expect this to be quite quick, quite sharp to the upside. And then you're going to want to see buyers who have been building position in here continuing to buy, to follow and to buy on pullbacks for the next legs up. Whereas the move down, because buyers are still positioning up, you can end up with, again, a situation where they start to progressively get stopped out and the move will then accelerate as we go down. So you'd be looking for this move to be fast and a pullback, and this move to be slow and acceleration. That's the way that you try to look at the difference between those two moves. Like I said, it's all about not just what should happen, but how it's going to do it, what you expect to see. You have a final variation on this as well, that once you get the break, if this doesn't bring in new buyers and starts to fall back here, then you can almost have this kind of bump and run type pattern where you fall back into the wedge and then you stop all of these people out, because all these longs who have been buying here, positioning to the upside, getting their average price progressively higher, they get the move thereafter. But if they don't keep buying, then what that suggests is in fact that they're actually now selling into this. They're exiting their positions and may well actually be sellers as the market comes back down. So you can then end up with this quicker drop down, because many of the people who would have stopped out have perhaps already got out for their profit and may well now actually be selling. So this provides you a few more options than this. This realistically is a move to be played back up because it's a very difficult move to actually define when it's going to go down. Similar in the way that a flag failing and actually moving down is not actually a trade that's very easy to actually play. Right, so let's go and have a little look at this. This is your flat-topped wedge that results in a continuation type move. Now, eagle-eyed of you, I'm sure someone's looking at this going, we've seen that before. We've seen this chart before, and absolutely we have. Talked about this, and I purposely cut off a slight bit of it just so that you guys, it's a way of remembering patterns. That if you can remember it from this, knowing that there was a little bit more to it, it makes that memory of that structure that little bit stronger. Now, the reason for doing that is it enables you to recognize this type of trend down pattern, failure to continue, and then break of trend towards the upside. It's essentially a bit of a wide, flat-bottomed wedge type pattern. But we're going to focus on the short time frame, which allows for the entry on this break towards the upside. We already talked about this as a hourly break of trend to the upside and a move through the recent highs. What a short time frame pattern does, it gives you that access, it gives you that precise point where you can get into this trade. This is it on a 5-minute chart. Now, what happens on a 5-minute is we get a boost up. So you get this nice little quick move up. This is around about 9 o'clock, so around about a UK data point. And that gives you this little kick towards the upside. So great. You've got a market that, from a data perspective, is slightly bullish. From a structure point of view, is slightly bullish as well. And then we bounce on that trend line. So you've now got an hourly trend line, which means this isn't just a simple 5-minute flat-topped triangle. This is a 5-minute flat-top triangle that leads you into an hourly and even you could argue daily trend break. That's significant. So now you've got a situation where you've got a pretty hefty target on this. What you're looking for then is this break. You're looking for and you expect this to be fast. Now, you've got this kind of flat-topped triangle and there's a couple of small highs just above here. So I'll be looking at this thinking, right, the moment that this breaks, I've got a couple of little spikes higher. If I can get in before there, that's where the acceleration is going to come from. Because everybody who's short in here is going to have their stops just above there. Not only is that on the 5-minute structure, but on the hourly as well. And this is what enables this move up. You get the fast jump as people get pushed out of trade, followed by, and this is the bit that I was talking about a moment ago, the steady progression afterwards. Buyers coming in on a pullback and then creating this steady movement higher. This bit here that you can see on a 5-minute is happening just here, and then you get the continuation of the move. So it's that compression that generates the energy to move. And once that move happens, the sellers who are selling continually on that trend break have to give up on trade. This brings in more buyers, which is exactly what's happening here. New buyers start coming in, they recognize the hourly trend break, and they then start to play this onwards towards the upside. So it's an access method to play for a wider structured trade. With these downward sloping wedges, this is what I typically use as a way of kind of describing what I call a struggling move. You will often have markets that struggle in what they're doing. They tick to the downside. They don't do it particularly quickly. Imagine yourself being in this type of trade. It's a market that never pushes you on side enough to really believe that this move is actually going to continue. It feels lethargic. It doesn't feel like it's got the energy to drive on. And this creates a problem. It creates a problem in risk management, like I talked about before. Where do you place a stop? If you've been selling it in here, very difficult to define a stop. And so therefore, what people end up doing is they define a stop by a generally reasonably arbitrary and therefore weak point that as the market starts to tip offside, that's when they start thinking, this doesn't look right. And they start to get out. And people are going to go, when I say offside, people's average price will go offside at different points. And that's what takes more and more people out. That's what then creates this quicker move back. To start with, if you're playing this as a break-off wedge towards the upside, you can have a target of the origin of the wedge. So where this sort of steady progression down comes. This isn't your kind of full-on smoking chimney type wedge, as I would call it. And this is more just a steady, struggling continuation move down. You know, we've moved within this range here, steady funneling down. We don't get the drive that you're looking for. Market struggles, and then you get the reverse back up. This is a bit more of a clean, straight line move compared to, if you think about it time-wise, how long this takes to form versus how long it takes to reverse. Much less time in here compared to here, because this is then just forcing that, or reversing on that struggle towards the downside. Essentially, a market that struggles down is a market that's running into enough buyers to be able to stop it from surging down. So we're going to go and have a look at, more specifically, the wedge created in here, the inability of a market to keep going. But this all starts off with, and this is an example in the NASDAQ. This all starts off with, again, a similar type of move towards the upside. Market that's driving higher, you know, again, this steady continuation, and then you end up with this compressed ascending wedge. The market is, you know, steadily getting closer and closer. What happens is you get the break to the upside. So this is one of those situations where you do get the continuation. This is the hard bit to play. That you need to see a very distinct change in the way the market trades here on the break, here on the break, for you to continue to play this move. Alternatively though, when this break doesn't materialize into anything, you know that the move's onto the downside now. Because buyers who have now started to come in are going to see it back inside the wedge and are now going to continue to exit. So what we're going to look at though in a little bit more detail is this move here, which on the face of it, on an hourly, doesn't look like much. But this is quite a significant point, because as you start to fall back below these previous highs, this could well be the beginning of a turn. You've now had a move higher that's clearly failed to the upside, put in a nice clear reversal candle as well, and then breaks back below this resistance come support zone. This is the chance to go down. This is what's going to bring sellers in. But the reality of what happens when you bring this over onto a 5 minute is that when you get through this low, this 16,275, it's just here, this level, we don't get this drive down. You do get one initial, sort of steady drive, but then you get this very deep pullback. Very deep pullback on a move like this immediately says that this isn't generating the selling pressure that you might be looking for. Nevertheless, sellers are going to come in to sell because we haven't got back above the 16,275 level. And as this move happens, people then come in and they sell on pullback, sell on pullback. This is the point where the move could keep going. This could be an element of a kind of pennant. And you see how, you know, the structures will build and sort of meander their way along. They'll build a structure, they'll break a structure. So you get this kind of pennant formation. Breaks the low. This is the chance to keep on going. And again, we break the next low. This is the chance to keep on going. But with each of these situations, every move down has this very, very deep pullback, and every break lower has this very small continuation. This puts people in a difficult situation because dependent on your style, you're always going to get pushed back on significantly. If you're a passive trader and you're selling on the pullback to the low of this little range here, you still get the market comes almost all the way back to you. That's not what you're looking for. If you're a breakout trader and you're waiting to form a low and then break that and sell, you get in a lot of trouble. It chops you around there. You sell on this break and yeah, it holds down marginally before then another quick reversal. So this generates uncertainty, discomfort among traders. You're going to talk about positioning. That's exactly what's happening there. Imagine wherever you've sold in there, you never get to a point where you feel confident that this is going, that this is the directional move you thought it was going to be. And this is why then when you break the little wedge that's forming, because this, you know, for those who are in, they're looking at places to put stop. They're looking at what allows this move to keep going. And this wedge then becomes that. And once the wedge breaks, that now allows people who feel that this is still a buy the chance to get in. Because now they're seeing a change in the pattern. They're seeing a change in the way the market's moving down. That allows them the chance to get in. It also becomes the first point where sellers can now start to doubt the move, where sellers do doubt the move, and where sellers start to exit. And this is what creates that movement up. So again, think about it from the point of view of how people are getting themselves compressed, what people's directional bias is and where that starts to change. For so many moves, the longer it takes to actually put in the next leg of the progression, the more and more people position and then get themselves essentially in trouble. They get themselves stuck, unsure what to do next, and that's where they get forced out of position.